All right, let's talk about something that gets a really bad rap in crypto: volatility. You know those wild, heart-stopping price swings? Most people run for the hills when they see it, but what if I told you it's not the enemy? What if it's actually your single greatest advantage? Let's dive in.
So I want you to completely reframe how you think about this. Forget seeing those crazy chart moves as pure risk. From now on, we're going to see them as the very thing that creates opportunity. Seriously, all that chaos, that's exactly where the potential is hiding.
Okay, so how does chaos actually turn into opportunity? Well, to get it, you've got to toss out that old textbook definition of volatility that just screams danger. In the world of active trading, it means something completely different, something much more exciting. Think about it like this. A flat, boring market is tough. You're basically just hoping things slowly creep up. But a volatile market, that's a two-way street. The massive swings up and the massive swings down both become chances to profit. Suddenly, the whole playing field just opens up. And this is just a brilliant way to picture a key signal that comes from all that chaos. That lightning bolt, that represents a super sharp, scary price drop, a liquidation wick. And the snowflake, that's exchanges literally freezing up because of all the panic. When you see those two things happen together, well, that's often a massive sign the market has hit bottom and a big reversal is right around the corner. Now, if you want to capitalize on this, you have to learn how to read the room. And I mean the entire market's room. It's not just numbers, right? It's driven by huge collective emotions. Is the crowd totally euphoric, or are they absolutely terrified? Let's look at a couple of ways we can actually measure that mood.
First up, we've got the classic Fear and Greed Index. You've probably seen this around. It's a really simple but super powerful tool that gives you a quick snapshot of what the herd, the majority of retail traders, is feeling. Are they greedy and FOMOing into everything, or are they fearful and panic selling? This tells you.
So, the strategy here? It's beautifully simple. You do the exact opposite of what the herd is doing. When this index is flashing extreme fear, say under 20, that's your cue to start looking for bargains. And when it's screaming extreme greed up over 80, it's probably a good time to think about taking some profits. It's that old saying, right? Be greedy when others are fearful, and fearful when others are greedy.
All right, next up is a more technical tool, the Bitcoin Volatility Index, or BVOL for short. Now, this one doesn't measure emotion. It measures the raw, expected choppiness of Bitcoin's price. When that line is way up high, it means big moves are on the horizon. When it's low, things are expected to be pretty calm. The trick is watching for when it hits those extreme highs or lows. And here's the secret sauce. When you see that BVOL chart hitting a major peak or a major valley, and at the exact same time, Bitcoin's price is sitting at a really critical support or resistance level, boom, that is a massively powerful signal that a reversal is coming. You combine those two, and you've got a really high confidence setup. Okay, so we know how to read the market's mood. But let's ask a bigger question. Who's creating that mood? To really master volatility, you have to understand the battle that's happening just under the surface, a tug-of-war between two totally different kinds of players. See, the whole market is basically a showdown between these two groups. On one side, you've got the aggressive traders. That's usually us, the retail crowd. We hit buy now or sell now. We use market orders. We're the ones actually pushing the price up or down. But on the other side, you've got the passive traders, the whales, the big institutions. They don't chase the price. They set their traps, their limit orders, and they patiently wait for the price to come to them. They don't move the price. They absorb our aggression. And that is the whales' game in a nutshell. They know retail traders are emotional. So what do? They help craft narratives. They make sure all the good news comes out at the top and all the scary news hits at the bottom. Why? To get the herd to either FOMO buy or panic sell. All that emotional trading creates a tidal wave of liquidity that they need to fill their huge orders without moving the price against themselves. And please, never ever forget this. This is the core truth of how these markets work. Your emotional decision to buy the peak or sell the absolute bottom, that's what provides the exit for a whale. The entire game is structured to get you, the herd, to act predictably so they can profit from it. So, if the game is rigged against the herd, how in the world do you win? Simple. You get the tools to see exactly what the herd is doing, and then you bet against them. Let me show you how. Okay, this right here is one of a contrarian's most powerful weapons. It's called Cumulative Volume Delta, or CVD. Think of it like X-ray vision. It lets you see the flow of all those aggressive market orders we were just talking about. When CVD is going up, it means aggressive buyers are in control. When it's falling, aggressive sellers are taking over. It's a window into what the herd is actually doing with their money, right now. Now the real magic, the aha moment, is when the price and the CVD start telling you two different stories. This is called divergence. If the price pokes up to a new high, but CVD doesn't follow, that's called exhaustion. It means the buyers are running out of steam. But even better is absorption. This is when CVD is pushing super hard, but the price just isn't moving. That tells you that all that aggressive buying or selling is hitting a giant brick wall of limit orders. A whale is trapping the herd.
So here's a dead simple checklist to put this into practice. First, check funding rates. Think of this like a tax on being popular. If rates are super high and positive, it means way too many people are betting on the price going up. Second, check open interest. If that's rising too, it means new money is flooding in to make that exact same crowded bet. When you see those things lining up, you know a trade is getting way too one-sided. And that's your cue to start looking to take the other side.
And always remember this first rule of market narratives. When every influencer is euphoric, when every headline is screaming about new all-time highs, when it feels like the price can only go up forever, you are probably standing right at the local top.
And of course, the opposite is just as true. When the news is nothing but fear, uncertainty, and doubt, when everyone is convinced it's all going to zero and you feel sick to your stomach, that is the moment of maximum financial opportunity. That's when you should be looking to buy, not selling with the rest of the panicked crowd.
So, look, here's the bottom line. Volatility isn't just random noise. It's the engine of the market, and it's fueled by the predictable emotions of the crowd. Once you understand the game, once you learn to read the sentiment and use the right tools, you can stop being the liquidity and start trading alongside the smart money. The only question left is, are you ready to stop following the herd?